Finance is the lifeblood of any business, and during times of crisis or high-risk exposure, financial resilience becomes the very foundation upon which businesses either survive or collapse. Financial resilience is not merely about how much capital a business has, but how intelligently, flexibly, and proactively it manages its finances, especially cash flow, to navigate uncertainty, minimize loss, and sustain operations. In this module, we dive into how entrepreneurs can build financial buffers, create cash flow strategies, utilize emergency funding techniques, and design cost-smart operational models that make them less vulnerable to external shocks and internal disruptions. After this module, you should be able to 1. Understand what financial resilience entails in entrepreneurship. 2. Identify sources of financial risk and instability. 3. Build robust cash flow management systems. 4. Prioritize spending and cut non-essential expenses without harming business health. 5. Evaluate financing options during crisis or high-risk phases. Make strategic decisions about liquidity, budgeting, credit, and reserves. What is financial resilience? Financial resilience is the business's ability to withstand economic shocks, recover from disruptions, and continue functioning during difficult financial conditions. It includes 1. Liquidity, having accessible cash or near-cash assets. 2. Flexibility, being able to reallocate funds or cut costs quickly. 3. Stability, maintaining essential operations during downturns. 4. Redundancy, having financial buffers, savings, or credit lines. 5. Foresight, planning for various financial contingencies. A financially resilient entrepreneur does not rely on a single source of income, funding, or financial assumption. Instead, they diversify, prepare, monitor, and adjust regularly. Understanding cash flow in risk contexts. Cash flow refers to the movement of money in and out of your business. It includes inflow, revenue from customers, loans, investments. Outflow, expenses like salaries, rent, utilities, marketing, supplies. During risky periods, economic downturns, disasters, crises, inflow may decrease drastically, while outflow remains or increases. This mismatch can create 1. Negative cash flow. 2. Debt accumulation. 3. Inability to pay staff. 4. Loss of creditworthiness. 5. Eventual insolvency. Hence, entrepreneurs must forecast, prioritize, and tighten their cash flow strategy to stay afloat. Key components of financial resilience. A. Emergency funds and business reserves. Having cash reserves is a cornerstone of resilience. It allows a business to 1. Cover operational costs during revenue slumps. 2. Avoid panic borrowing or high-interest loans. 3. Retain key staff and assets. Resilient businesses typically keep 3 to 6 months' worth of expenses in a liquid reserve. B. Diversified revenue streams. Entrepreneurs should avoid over-reliance on a single income source. For example, 1. A gym offering only physical training can include online classes. 2. A fashion brand can add downloadable style guides. 3. A restaurant can offer packaged sauces or e-books. Diversification cushions income when one stream is affected. C. Cost management and budget reallocation. In risky periods, smart entrepreneurs. 1. Categorize expenses as critical, flexible, or non-essential. 2. Defer, renegotiate, or eliminate non-essential costs. 3. Invest only in activities with clear short-term or long-term ROI. 4. Renegotiate rents, suppliers' fees, or utility plans. Cash flow management techniques in crisis. A. Cash flow forecasting. This involves projecting your future cash flow, inflow and outflow, over a 3, 6, or 12-month period. It answers, will we have enough money to pay bills next month? When will we need a loan? Are there revenue gaps we need to plan for? B. Tight receivables management. Issue invoices promptly. Offer discounts for early payments. Follow up consistently on late payers. Avoid offering long credit terms during high-risk times. C. Staggered payments and supplier negotiation. During a cash crunch, negotiate to delay or break down payments into smaller amounts. Swap services, barter, to preserve cash. Get grace periods on existing credit obligations. D. Lean operational models. Adopt lean startup principles. Use only essential tools and staff. Outsource instead of full-time hire. Go digital to cut office utility costs. Shift from fixed to variable costs, e.g., remote teams versus office rent. Accessing emergency funding. In situations where cash flow management is not enough, entrepreneurs must seek external funding options. These include 1. Government grants and stimulus programs. 2. Low-interest SME loans. 3. Angel investors willing to back pivots or resilient strategies. 4. Crowdfunding from loyal customers or online platforms. 5. Revenue-based financing or invoice factoring. Each funding type has implications for ownership, interest, or repayment, and must be chosen with strategy in mind. Building financial monitoring systems. Resilient entrepreneurs regularly track 1. Daily weekly cash flow. 2. Accounts receivable and payable. 3. Gross profit and net income margins. 4. Working capital ratio, assets versus liabilities. 5. Burn rate, monthly net spending. These metrics allow for real-time financial decisions instead of reactive panic. Psychological discipline and financial risk. Financial resilience is not just technical, it's behavioral. Entrepreneurs must 1. Avoid impulsive spending. 2. Say no to unnecessary expansion during uncertainty. 3. Accept temporary frugality. 4. Communicate transparently with staff and creditors. 5. Embrace creative ways to preserve cash and value. The mindset of doing more with less becomes a survival skill. Case study: restaurant chain pivot during lockdown. A mid-sized restaurant chain in Lagos, Nigeria experienced a 70% drop in revenue during COVID lockdowns. Instead of closing, 1. They immediately launched delivery services. 2. Negotiated rent reductions. 3. Offered DIY meal kits. 4. Applied for government survival grants. 5. Suspended all non-essential marketing. They survived and reopened stronger with a new revenue stream, meal kits, and leaner cost structure,